The Federal Reserve faces a new challenge, hotter than expected inflation and jobless claims jumping to a year high. The double whammy has bond traders second-guessing the quarter-point Fed cut bets next month. Our next report telling you more.
Bond traders dialed back their expectations for easing in November. This comes after a Federal Reserve official opened the door to skipping a cut. Hotter than expected inflation and a slowdown in the labour market have amplified the debate on whether the Fed will opt for a smaller rate cut next month or a pause. This comes after the Fed's large cut in September. Wall Street did not view Thursday's economic data as disastrous. However, it did show how difficult it is for the Fed to return inflation to its 2% objective. This has further fueled speculation over the Fed's future moves. Bond market participants, for the time being, are still betting that the central bank will cut rates by 25 basis points in November. However, they are now pricing in about a 75% chance versus as much as over 80% before the inflation data. Atlanta Federal Reserve President Raphael Bostic told the Wall Street Journal he would consider a pause in rate cuts. Fed minutes reinforce exceptions that the central bank's half-point cut in September was more of a one-off event. The minutes also showed some officials preferred a more steady pace of rate cuts. Chris Larkin at E-Trade from Morgan Stanley said, "One slightly hotter than expected CPI reading does not mean a new wave of inflation has been unleashed. But the fact that it accompanied a jump in weekly jobless claims may add to short-term market uncertainty." He added, "These weren't good numbers, but that doesn't mean they upended the larger outlook for solid economic growth and moderate inflation." The latest inflation read signals the risk that the Fed does not fully have price pressures under control. What will also weigh in are the escalating and widening tensions in West Asia and how oil prices move. At the same time, Thursday's jobless claims tell the Fed more easing is needed. The US presidential race brings another set of risks for the Fed. For now, the independent central bank faces multifaceted challenges with a divided committee on the rate path. Business Bureau Report, WION World is One.
And well, for more on this, we're now being joined by Dr. Andrew Ferris, CEO of Ecogenesis Advisory Limited. He's joining us live from Hong Kong. Welcome to the broadcast, Mr. Ferris.
Delighted.
First up, what is your take on the Fed's next move in November?
No move, no change in interest rates. They can't risk of a cut at the time that inflation is definitely not under control. And the signs from the labor market are actually conflicting. We had an increase in subscriptions to the unemployment benefit facility. And at the same time, we had exceptionally high non-farm new jobs. So it isn't quite true that the labor market is getting poorer or cooler, and therefore that will encourage the Fed to cut.
But you speak of how Yes, please.
I don't see that at all.
Right, Mr. Ferris, you speak of how there are signs in the labor market. Mixed data has markets on the edge right now. What is your view on that?
My view is to repeat, the Fed is not going to cut. The Fed changed from inflation to labor market, and when the labor market appears to be strong, that encourages them, in fact, to go with a 50 basis points cut, which was controversial within the Fed itself. Now, inflation, if they're going to Fed has an inflation target, it's not meeting it. The CPI and the PCE numbers are both have got the big, strong 2% in front of it. In the PCE, actually, it is 3% in front of it. But the Fed never used the PCE as a targeting device for the number. But for the CPI, okay, the inflation rate is 2 point something. It is not 1.9 something. So the Fed is not meeting that target. And by cutting interest rates, it's not going to help.
Right. You say that there will be no change in November. Will that hurt Fed's credibility after a large cut in September?
I don't think the Fed has a great degree of credibility right now because we had a year of yes, no, no, yes, we'll follow the data, yes, will, no, will not follow the data. We have two targets, one of which we disregard, the other one we disregard again. So frankly, what I'm telling my clients is follow your own interpretation of the data. Forget the Fed, okay? Because if you try to outguess the Fed, you will be wasting your time and possibly losing money. Remember, I'm not saying the Fed is not important. It is very important, but I think there are other things in life that try to outguess a Fed that hasn't got a very clear view as what it wants to do. Made things, of course, worse by the fact that if they cut interest rates, Trump may say that he's helping the Democrats, although a cut in interest rates would also help in Trump. If the Fed doesn't do anything on interest rates, people will be complaining that it is not controlling inflation. So whatever the Fed does, it's going to appear wrong. That's why my advice to my clients is follow your own sense, look at the data and decide. Don't wait for the Fed to cut or not to cut.
Right, Dr. Freris, thank you for joining us on World Business Watch with your insights.